Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. I'd recently noted how on Friday 4 weeks ago the market made a key reversal up, if only just, based on what had become a solid support from the November 2014 high at 201.25. This daily key reversal up drew a maximum effort to try to move higher, though some weeks, especially more recently, have been better than others. You see, since early October, prices started to ping-pong between the November 2014 high, support actually, below the market, and the July 2021 high at 217.85 on top. Then finally 2 weeks ago the market got fed up of the range, and 2 Tuesdays ago made another key reversal up. Initially on the following Wednesday it looked like business as usual, a bearish dark cloud cover pattern type action, but this time it was really different, as by the Friday prices punched up and closed over the July high at 217.95, and by some distance as well. It was this distance which was the key, as the market had thus made a weekly key reversal up 2 weeks ago. Last Monday the move up continued, but by last Wednesday prices having punched up and over the October 2014 high at 229.15. However, by the middle of last week some indecision has started to creep in, initially with a bearish dark cloud cover pattern, which was offset by Friday's immediate countering bullish harami. However, this has not been any follow-on. There's not been any follow-on higher today, nor, if I'm honest, has there been any counter to the move. What we have so far today looks very much like an indecisive spinning top. So what's next? Well, we still have from below all the ammunition obtained over October to early November between the 201.25 support and the 218 even resistance. So will this rally continue? Well, at the moment I'm not sure. You see, I could look at the whole of July today action as a type of ascending triangle, but the action looks very inelegant. I'd rather rely once again on the two nearby resistances we have above the market, the 2012 high at 241.05 and the November 2011 high at 243.40. The reason is that once those are overcome, well, we have little on top until the October 2011 high at 255.05. I also put down the wide action late last week to no significant support or resistances between the October 2014 high at 229.15 and the 2012 high. This does go a long way to explain the recent indecision. London coffee. Since the middle of September until late October, the market had maintained a sideways action roughly between 2100 below and the August 2017 high overhead at 2173. 4 weeks ago the market took a move higher up to the next congestion at 2279, or what was the whole of 2017's high, where, somewhat surprisingly given the amount of ammunition that had been stored over that mid-September to late October period, the market ran out of steam and formed a pipe top. Early 4 weeks ago that was. However, once prices fell after this formation, they got stuck, sitting now on top of the very same range, roughly between 2100 to 2173, that prices had been caught in only a week or so before. This has now happened 3 times over the last 4 weeks. Prices supported at 2173 and the June 2017 high at 2177, but capped by the 2107 the 2107 high at 2279. I'll get that right eventually. Late 2 weeks ago prices even managed to break up over this high, but have since fallen back within the range again. All this action has put paid to ideas of a rising wedge pattern, which I had put forward as a possible solution last week. This and another factor may be what are holding up prices. I spoke about this last week and I quote, "You see, I suspect the rising medium moving average, that's currently at 2162, put off further declines because the moving average has been partnering upwards with the August based uptrend, again, since retired. Since it began, I think the market knows that to break the uptrend and the rising wedge, you would also have to break its partner, the medium moving average. And that was just one move lower too much. Thus the horn top was not fulfilled and prices turned back up again." End of quote. The August-based uptrend is now retired, and all that is left is the medium moving average, so it is worthwhile paying close attention to it. Since all this has happened, I've done nothing here that I haven't. I've done something here that I haven't done since, I think, the 1990s. I've drawn something here that I wouldn't have done. I've drawn an optimized bullish Andrews pitchfork to take into account the bullish channeling we have seen since the start of this year. Thus, I have a late January to late July bullish Andrews pitchfork, with the market in between the middle time, currently at 22.40, and the upper time, currently 23.82. Strange times require strange tools. I would like to finish with one thought on this market. Please do remember that we still have a weekly key reversal up 2 weeks ago, and that may well be the driver for this market, as we're in an area that is fairly bereft of major support or resistances, bar those already mentioned. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.